Well, Claire is going to start off by talking about the fund strategy and do our usual quarterly review, taking in the global market context, the strategy review, and our outlook as we move forwards. And then we're going to focus down on our water theme in the second half of the webinar. For the eagle-eyed and the diligent of you who've already read our quarterly report, you will have seen that Katie Woodhouse wrote an excellent piece on our water theme in the latest quarterly report. And so Katie and Seb are going to come on to in the sort of second section of the webinar and talk through some of their findings there. So without further ado, I'll hand over to Claire. Thank you, Claire.
Thanks, George. So let's start out by taking a look at some of the most important market events that occurred during the quarter. So the main event probably occurred on the 4th of July, which was that Trump's One Big Beautiful Bill was signed into law. The main premise of the bill was to extend the tax cuts that were established during Trump's first term. And to pay for the bill, deep cuts were made to social health program, Medicaid, renewables, and food benefits. Although in reality, this bill extends America's fiscal deficit by trillions of dollars. Fireworks showered down over the White House, so I'd suggest from this chart that it doesn't look like something that a lot of Americans will be celebrating. And the headline here is that it could have been worse. The bad news is that it completely terminates EV tax credits, as well as consumer credits for rooftop solar and energy efficiency improvements for the home. We actually pivoted our strategy away from rooftop solar some time ago, so that's not a direct impact for our strategy, although EVs and energy efficiency are a big part of our strategy. But the good news is that our clean energy bets are predominantly in domestic manufacturing of utility scale solar and wind. And here, manufacturing tax credits were left more or less untouched. This is a huge relief because a lot of solar and wind manufacturers' gross margins have really benefited from this tax credit and will continue to do so under this bill. Meanwhile, the bill actually increases tax credits available for semiconductor factories or fabs. Most of our EV and energy efficiency exposure is in the value chain, mainly through semiconductors. So that actually helps to offset the loss of the EV and home efficiency credits, at least for our strategy. The big sticking point, though, is investment tax credits relating to solar and wind. These are potentially extended until 2030, but there are some caveats, and recent headlines suggest that Trump is still trying to attack these through other means, even now the bill has passed. So it's a mixed picture, but definitely could have been worse on the clean energy side. The health sector probably looks worse off by comparison. The changes to Medicaid are projected to increase the number of uninsured people in the US by tens of millions. This could reverberate through the health sector as negative impacts on hospital and insurance budgets will likely filter down to hospital capex spending, impacting medtech in our investment universe, and will simply reduce the amount of money available for R&D across the sector. Like with renewables, Trump's bill isn't the end of the story here. Robert F. Kennedy Jr., the health secretary on the left here, has been very vocal in his distaste for US healthcare spending and honestly for the scientific method in general. Tariffs, cuts to federal spending, and executive orders all still rumble on and aim to take chunks out of the pharma sector in particular. Probably the main headlines to look out for here relate to a most favoured nation's executive order in healthcare, which marks a direct attempt to lower US drug prices across the board. And while US drug pricing is a controversial issue, this policy would almost certainly have a detrimental impact on R&D spending by pharma companies and demand for their suppliers. Speaking of tariffs, demand and consumer confidence continue to look wounded by the unrelenting pace of tariff headlines and geopolitical news. The chart on the left shows a broad-based indicator meant to judge levels of economic uncertainty by capturing things like newspaper headlines and the level of disagreement between economic forecasters. As you can see, economic uncertainty in the US is the worst it's been since COVID, which itself was the highest reading on record. Meanwhile, as you can see on the right, consumer confidence is approaching the lowest levels in the past 10 years, and it's probably fair enough. Both of these charts are indicative of weak demand across the US economy. However, we have seen improvements in manufacturing PMIs or purchasing managers' indexes, which are a leading indicator of industrial demand. The way to interpret this chart is that a reading above 50 indicates that manufacturing demand is expanding, and below 50 indicates that demand is contracting. As you can see, manufacturing demand in the US has crept above 50 into expansion, and Eurozone demand is about balanced. This could imply that Trump's policies are sort of having their desired effect, incentivizing domestic manufacturing, which is leading to increasing industrial demand. And this is something we're actually positioned for in our portfolio through companies like Rockwell, Trimble, and Trane, all of which are indexed to US domestic manufacturing expansion. So now let's take a look at how our strategy performed during the second quarter. And this chart shows how our strategies performed against various indexes which are intended to provide some context. And you can see that clean energy outperformed, which is probably due to relief that the one big beautiful bill wasn't as bad as a lot of people had expected. And mid-caps also outperformed. These tend to be more domestically oriented and less exposed to geopolitical crosswinds like tariffs. They also tend to be more agile in their response to global events due to their smaller size. So it's perhaps no surprise that they've been attracting capital recently. Health, though, underperformed as a result of all of those headwinds that I mentioned earlier, and our strategy is in the middle of those conflicting forces and slightly underperformed the MSCI World during the quarter. Another factor to take into account here is the extreme market concentration of global equities, particularly in mega cap tech. After taking a bit of a breather at the end of March, we saw the large cap tech stocks continue to drive index returns led by Nvidia, although poor Apple has been left out this time due to some stock specific issues. Due to the unprecedented level of market concentration in these stocks, whenever we see a rally like this, it does tend to result in our strategy underperforming the global index, since our sustainable impact mandate means that we simply can't invest in these companies. And this chart shows the cumulative weight of the MSCI World's top 10 positions through time, going all the way back to the 1970s. Their chart ends at 2023, so I've added a little marker to show where we are now, which, by the way, is even higher. As you can see, today the top 10 stocks account for 25% of the MSCI World's market cap. This is higher than every other period of extreme market concentration over the last 50 years. This includes the internet boom of the noughties, the Japanese finance bubble of the 90s, and the period in the 1970s when only a handful of US industrial companies dominated the world. So when we say extreme market concentration, we really mean it. This slide shows how our strategy has performed over the longer term. And as you might remember, we recently removed the MSCI World Index as our benchmark because our investment universe just doesn't have much overlap with that index. So instead, we're now showing you our performance relative to a broader set of investment alternatives, including equities, bonds, and cash. This slide shows our performance for the quarter in absolute terms. As the first bar shows, our fund delivered an absolute return of around 2% in the quarter. Looking at the contribution by theme, health was by far the biggest attractor from returns, which might not come as a surprise given what I've shared earlier in the presentation. But more positive returns from the resource efficiency and sustainable transport themes, and to a lesser extent, safety and clean energy, more than offset this negative effect during the quarter. And this looks at which stocks were our best and worst performers during the quarter. And I'm going to spend some time now just looking at some of the biggest movers. So the strongest performing stock this quarter was Infineon. Infineon's the global leader in power semiconductors. And partly its strong performance this quarter can be explained by positive sentiment for the semiconductor sector as a whole, driven by Trump's big, beautiful tax credits for semi-manufacturing and the AI boom. But as the chart on the left shows, Infineon has even outperformed the wider semi sector, as captured by the Philadelphia Semiconductor Index shown in light green. Partly, this is due to strong execution. Infineon has recently become the global leader in microcontrollers, as you can see on the right, and they've assumed this position over just 3 years by making some clever acquisitions and taking market share organically from their competitors. And moves like this give us confidence that Infineon is well positioned to be a long-term winner in electrification. The second best performer was Trane, a US company specializing in HVAC equipment, which stands for heating, ventilation, and cooling. As you can see on the left, Trane has consistently been delivering strong double-digit revenue growth quarter after quarter. And partly this is because their HVAC products are being sold to data centers, which have been booming. But longer term, the reason we really like Train is their market-leading position in commercial HVAC solutions, particularly their focus on sustainability. Train has committed to a gigaton challenge where they seek to save their customers a gigaton of carbon emissions by 2030. This also usually has the benefit of saving energy and costs for their customers. One of our worst performers during the quarter was British pharmaceutical company AstraZeneca, and the eagle-eyed among you might remember that this was one of our best performers last quarter, and it really is a case study in how frustrating it can be to be a fundamental investor at the moment. The last quarter, we were telling you about a Chinese investigation into one of AstraZeneca's employees. That investigation now is solidly in the rearview mirror with very little impact to Astra as a corporate entity. So last quarter, the shares responded very, very well to that kind of recovery. But now Astra has been struck by pharma tariff headlines, as well as indications that the US government is aiming to negotiate more strongly on drug prices. And so that has led to its underperformance this quarter. As long-term investors, we are trying to put this noise into perspective by remembering our long-term thesis for AstraZeneca. This is a company that still aims to add about $25 billion in incremental revenue between now and 2030 by launching best-in-class drugs that can transform patient outcomes in a number of therapies, particularly in oncology. The company has a strong catalyst path in the second half of the year, and one we are particularly interested in is their trial for a new treatment for non-small cell lung cancer. Lung cancer is the leading cause of cancer deaths globally, as you can see on the right, and one of the drugs currently in development by Astra has the potential to create a new first-line standard of care in this disease. But this is just one of many drugs in Astra's pipeline, and it is its breadth and speed of pharmaceutical innovation that we think will enable the company to outperform over the longer term, even despite Trump's worst efforts. And the most significant detractor from returns this quarter was life sciences giant Thermo Fisher. This is partly due to funding cuts to the National Institute of Health, or NIH spending, made by Robert F. Kennedy Jr. himself. As you can see on the left, compared to their peers, Thermo is in the middle of the pack in terms of their percentage revenue exposure to NIH funding. However, due to their sheer size, in dollar terms, they are by far the worst affected. Longer term, we continue to like Thermo due to its leading market position and its historic track record of delivering exceptional value to its clients. As a recent example, Thermo's clinical research division has developed a new platform which uses machine learning to optimize clinical trials. The tool reportedly shortens study timelines by about 1.5 months, which can also save a lot of money. And in a world where pharma clients are increasingly under pressure, this time and cost saving could prove extremely valuable. So now let's move on to talk a bit about the outlook for our strategy. Although things are looking quite tough for the healthcare sector at the moment, there are still reasons to be optimistic about some of the things going on in this space. Firstly, while pressure on US health spending will create a difficult trading environment for a while, it's important to remember that most large pharmaceutical companies have plenty of cash. Drugs can sometimes act almost like annuities, as pharma companies receive annual revenues from drugs with marketable lives of 10 to 15 years. This has allowed Big Pharma to increase spending on R&D, both in absolute terms and as a percentage of revenue consistently over time, as you can see on the left, and we expect this will help them to remain somewhat resilient to policy pressures. Also, the companies in our portfolio typically have global supply chains, and this includes pharma companies like AstraZeneca, whose global footprint is shown on the right-hand side. Most of their US therapies are already manufactured inside the US, and what isn't can easily be relocated. So their supply chains aren't as vulnerable to tariffs as President Trump might have us believe. We've also seen a significant acceleration in AI spending by the pharma sector in recent years. Almost $10 billion of AI deals were made in this space during 2024, as you can see in this chart. Increased AI spending should drive R&D efficiencies. This should free up additional capital and potentially help pharma companies withstand political pressure on costs. Investments in AI and biosimulation could also increase spending on life science tools due to the need to validate AI algorithms. This means more and better training data needs to be identified and produced, which would largely come from traditional wet lab experimentation supported by companies like Thermo Fisher and Danaher. On the environmental side, we've said it before, but it's important to remember that the economic advantages of renewable energy, particularly utility solar and onshore wind, really are undeniable. It's for this reason that renewable energy deployment in the US has grown consistently over the last 2 decades, irrespective of which political party is in power, and we expect this to remain unchanged. Further, as you can see on the right, for all the drill baby drill rhetoric that comes out of Texas, one of the most powerful and most vocal opponents to renewable energy, they've actually been driving most of this clean energy demand. Texas is a big state which needs power, and renewable energy is cheap and fast to deploy. It's also important to realise that we're currently witnessing an historic reacceleration in power demand in the US. Since the 1950s, we've seen consistent annual declines in power load on the US grid, as shown on the left, partly benefiting from innovations in energy efficient technologies like compact fluorescent lamps in the noughties and LEDs in the 2010s. And some of our oldest clients may remember when we had investments in these technologies in our portfolio. But now we're going back to the future, like Doc Brown on the right there, as we're seeing energy demand rise again for the first time in decades. Energy analysts attribute this to one thing, the growth of AI and data center capex. And this is just the beginning. The chart on the left here from Bloomberg shows just how much pressure data centers could put on US grids over the next 10 years, broken down by region. It shows data center growth forecasts divided by the various energy markets in the US, which are effectively regions. The region which is expected to see the most pressure is called PJM. This includes Virginia, home to Data Center Alley, and Ohio, an emerging growth hub. Already, surging power demand in both of those states is exposing issues with infrastructure and tensions with utilities. And the second biggest region is expected to be ERCOT, where the T stands for Texas. Unlike PJM, ERCOT covers just this one state where huge amounts of space and workforce availability is expected to attract more data center capex and need more power. Texas has historically been the home of crypto mining, which is probably part of the reason why they've needed to add so much clean energy capacity in the first place. And finally, if you take one thing away from this presentation, it should be this. As we've been trying to stress repeatedly over the last few quarters, this opportunity set has never looked so cheap. Due to weak sentiment in both the environmental and the healthcare side of our investment universe, our portfolio is now trading on valuation multiples not seen for a decade. I would look at these charts and ask yourself, is the state of the sustainable economy really this bad? We don't think so. We think this is possibly the best valuation opportunity we've seen in years for investors that have the patience and the grit to see it through. And with that, I'll hand over to Seb and Katie, who are going to give a bit of an update on what we've been up to and our water management theme.
Very good. Thank you, Claire. Good morning, everybody. So I'm Seb Beloe, and I'm just going to spend a few minutes introducing some high-level comments about our water management theme, and then I'm going to hand over to Katie Woodhouse, who's a member of our investment team here at Foresight, working on the WHEB funds, and she'll talk through some of the individual stocks that we own in this theme. So if we go to the next slide, thank you. So for those of you that tuned into our Impact webinar just a few weeks ago, you may remember that one of the things that I mentioned that we've done over the past 18 to 24 months or so has been to build out our exposure to the water management theme, which is shown in that blue segment in the middle of the chart, which you can see here. This is really as a result of a gradual shift that we've made away from the more volatile and higher impact parts of the investment universe and towards some of the themes which are a bit steadier parts of the market. They're all still impactful. They're still delivering a positive impact, but they are less exposed to the more or to the really intense negative sentiment that we've seen around the net zero carbon stocks that are exposed to the net zero carbon transition specifically. It is the result also of a bottom-up process. We're not kind of setting in place top-level targets. It's driven by stock selection and a bottom-up process. And it really started in 2023 when we added a new water position, Veralto, to our existing holdings in Ecolab and Xylem. And then last year in 2024, we then added American Waterworks, which is a US water utility, and that took the exposure in the theme from around 8% to just under 14%. And then since then, we've also added Kurita, which is a Japanese manufacturer of water treatment equipment and services. That shift of 6% from 8 to 14% may not sound like much, but we've never actually been above 10% before in this theme over the 20 years that we've managed this strategy. So it is a significant shift in favor of over a more defensive and steadier part of the market, as I said. So if we could just go to the next slide, please, Katie. Water management is an attractive part of the market for a number of reasons. First of all, as I said, it avoids much of the toxicity and policy volatility that we've seen in those sectors that are directly connected to the net zero carbon transition. And in fact, it's interesting, I think, to note that in the One Big Beautiful Bill that Claire mentioned that was passed just a few weeks ago, there are provisions for federal money to be spent on water infrastructure, both in terms of water storage to help communities that are vulnerable to water scarcity, in watershed protection, in flood prevention, and also in groundwater protection, areas that one would not perhaps normally associate with the Trump administration. But these issues are so acute now that even in the One Big Beautiful Bill, they get support, albeit relatively modest, but nonetheless they are singled out for support. So that's an attractive reason to be involved in water management. Businesses in this sector also support a healthy mix of both public and private markets. Many water utilities are still municipally owned in the US and also elsewhere. And this market tends to be relatively low growth, but also a steady source of revenues for companies involved in providing the water treatment technologies. The industrial market is more cyclical, but it's also higher growth and higher margin. So it's nice to have exposure to both of those end markets. In addition, in recent years, we have seen a significant and sustained growth in the water market in many regions. Partly this is due to more funds being available to support the replacement of aging infrastructure, which is a big deal in a lot of countries, including in this country, in the UK. There's also been investment to support in response to stricter regulation. So, for example, removing hazardous chemicals like PFAS chemicals from drinking water has been an area of investment. And in reality, of course, the impacts of climate change are often experienced through the medium of water, either too much, too quickly, or too little, and often both of those things, as we've had in the UK in recent years. And water infrastructure is a key element in mitigating and adapting to this change. And we think that this is probably behind the growth in expenditure that you can see very clearly in the graph on the right-hand side, which comes from the Federal Reserve Bank of St. Louis. And that covers all US expenditure on water supply. And you can quite clearly see that ticking up in recent years. And in the UK, of course, we've not been investing enough in our infrastructure, and hence the problems that we all know so much about. And the report that was published just earlier this week on Ofwat and the new approach that the government is pursuing there will increase the amount of investment in water infrastructure in this country too. And this is obviously a global trend. In fact, in many of the emerging economies, these issues are even more acute. And actually, we were at Foresight, we hosted an event during London Climate Week just a few weeks ago on water resilience. And we had over 50 companies attend that event, including companies like Heineken, Coca-Cola, and Diageo, who were able to make the case very clearly that water is absolutely essential for their businesses. Of course it is, they're beverage businesses. But there were other companies there as well, like GlaxoSmithKline, the Lego Group, Tesco, and Vodafone, who were also very vulnerable to a lack of water and very interested in finding solutions. So this is an area that, in our view, will continue to receive long-term support and represents an attractive area of the market in which to invest. And I just wanted to, with my final slide, just bring this back home a bit. Water has clearly been a hot topic over the past few years, and then particularly this year. This picture is of Lindley Wood Reservoir in Yorkshire, which is classified as being at an exceptionally low level. In fact, Yorkshire's reservoirs as a whole are collectively just over half full. The UK as a whole had its 6th driest spring in nearly 2 centuries, and in England it's the 2nd driest on record. So clearly these are issues that are affecting us very close to home as well, and we're very much invested in the companies that are trying to address some of these challenges. And with that, I'll now hand over to Katie, who will talk through some of the holdings that we have in our water management theme. Thank you very much.
Great, thank you, Seb. So starting with one of our more recent entries into the water management theme, American Waterworks. We initiated the position in the summer of 2024, and what attracted us was the compelling valuation and the really strong alignment between impact and investment. American Waterworks provides drinking water and wastewater services to 14 million people across 24 US states. This equates to 1.2 billion cubic meters of drinking water and 101 million cubic meters of wastewater treated every single year. One of the company's main priorities is customer affordability. For 20% of households across the US, water bills account for 4.5% of household income, whereas for American Waterworks customers, the average monthly bill is just 0.8% of household income. Now, in stark contrast to our notorious water utility companies here in Britain, American Waterworks consistently exceeds water quality standards, outperforming both industry averages and regulatory benchmarks. Longer term, this is a company with a strong track record, consistently delivering high single-digit earnings growth. There are 2 major drivers of that growth. Firstly, there's a long-term investment cycle underway in the aging US water infrastructure. The average US water pipe is 45 years old, and some are over 100 years old, with almost half of this infrastructure classified as poor or worse. The Environmental Protection Agency estimates that $744 billion worth of investment will be needed over the next 20 years for upgrading this infrastructure. American Waterworks is contributing to this cycle by investing $37 billion to its CapEx program over the next 10 years, and this will go towards upgrading the infrastructure and modernizing the treatment plants. This leads me directly on to the next growth driver. Each blue dot on this map represents a different water system, clearly showing how fragmented the water utility market is in the US. There are over 50,000 water systems and 17,000 wastewater systems, the vast majority of which are operated by the municipality, and 90% serve a population of 10,000 people or less. Many of these small and medium-sized systems simply don't have the capital or the expertise to address the aging infrastructure. There's a huge opportunity here for consolidation, and this will help drive that infrastructure improvement cycle. American Waterworks is really well positioned for growth through the acquisition of these smaller systems. The company has 22 acquisitions currently in the pipeline, which will add more than 43,000 customer connections. This creates operational synergies and supports the long-term earnings growth. But addressing water concerns isn't solely about drinking water and wastewater. Seb mentioned several large corporations looking to become more water self-sufficient and reduce their water usage, which is where our newest holding in the water management theme really excels. Kurita Water is a Japanese water treatment company with a strong presence across Japan, Europe, and parts of Asia. Its offering includes both the chemicals and the systems, delivering solutions that save fresh water and reduce waste. In 2024 alone, Kurita's products saved 111 million cubic meters of water. Importantly, the company is deeply committed to environmental responsibility. Its strategy, known as creating shared value, integrates social and environmental impact along with economic outcomes, an approach that's becoming more important as industrial companies seek greater water self-sufficiency. This strategy is central to its business model, and it means that Kurita solutions don't just benefit customers by reducing their costs, but also deliver clear environmental and social value. Now, this is achieved through a reduction in water usage, lower energy use, which leads to a reduction in CO2 emissions, and less waste, improving resource recovery. One of the company's main end markets is the electronics industry, in sectors like semiconductors and solar cells. These products require ultra-pure water, and Karita is one of the global leaders in ultra-pure water production and recycling systems. Karita's end-to-end solutions enable chip makers to reduce water and cut emissions, as well as comply with environmental regulations. Karita is deeply embedded within the semiconductor manufacturing process. As Claire mentioned earlier, there's been an increase in funding allocated to semiconductor factories, with huge capacity increases expected across the world over the next decade. So Karita is really well positioned to benefit from this global CapEx spending semiconductors. I'll finish with a quick reminder of the other portfolio holdings in our water management theme. Ecolab has been in the portfolio since 2012 and provides water, hygiene, and infection prevention solutions to various industries, significantly reducing or even eliminating water as an input. Its strong service model and technological edge give it robust competitive barriers. To make this a little more tangible, in 2024, Ecolab helped customers save 856 million cubic meters of water. That's the equivalent drinking water for 781 million people for a whole year. Xylem, in the portfolio since 2014, provides products for treating water and wastewater, as well as smart water solutions to improve water efficiency. Xylem has a strong position in both those defensive municipal markets and the higher growth private markets. Again, to put some numbers to this, Xylem helps customers treat 3.6 billion cubic meters of water for reuse. Finally, Veralto, a more recent spin-out from another of our portfolio companies, Danaher. Veralto has 60% of its revenue coming from water quality solutions. Its technologies for water testing and treatment reach 40% of the global population and help save 303 million cubic meters of water annually. Veralto leverages the Danaher heritage to its enterprise system, helping to create cost efficiencies within the business, and we see strong momentum from its focus on higher treatment standards and ESG performance. And with that, I'll hand back to George for the Q&A.
Thank you, Katie. And yes, if everyone can bring their cameras back on, we've got the team lined up for Q&A now. So the Q&A function on Zoom is open. It has been through the call, so please do add any questions that you have, and we'll try and address them now. I'm going to address the first one myself, which was whether there are any measures that we're considering to deal with the underperformance in the strategy. So clearly, it has been a very difficult period. We've discussed this before in previous webinars. I think it's important that we differentiate between the kind of structural exposures of the strategy and our actions in terms of our investment stock picking. So we do quite a lot of work internally to understand what the drivers of performance are and what the drivers are relative in terms of relative performance, both to mainstream indexes and in the context of our opportunity set. And it's pretty clear that the structural exposures of impact are what have driven the more difficult investment environment over the last 3 or 4 years for impact stocks in the higher interest rate environment, the more difficult political environment, and the like. So those things remain. We do look for opportunities to expand our investable universe, but with always remaining with a very conscious and rigorous approach to ensuring that we focus on impact. But as Claire has just explained, we think that the opportunities, both in the portfolio and in our opportunity set at this stage, from a valuation perspective, are particularly attractive at the moment. So yes, we are always looking for opportunities to expand our opportunity set, to look at areas of the market which we can get invested in that are still focused on impact. We continue to evolve our investment process to be introspective in that sense, in terms of understanding how we can improve our stock picking. But the driver of returns has been very much from the structural focus of the universe. But we do think, looking forward, that is quite well positioned given the valuation opportunity in the space as we stand today. So with that, I'll then move on to the next questions that we've had, and maybe I'll come to you, Claire. I guess relevant to that last question as well, is just wanted to ask about AI. There's a question come through on that in the sense of AI has been very much the market's focus, and clearly that is driving a lot of change in the investable background. how do we focus? How do we address AI as an opportunity for us when we're not investing in the actual AI platforms?
Yeah, it's a great question. It's one that we have been getting a lot recently. Obviously, we are running a mandate which invests in companies whose products and services generate a positive environmental or healthcare impact. And so it's been difficult for us to justify investing in NVIDIA, which of course is the main company that has benefited from that AI boom and the main reason that our fund has looked weak relative to the MSCI world. Our focus, though, is to invest in companies who actually leverage the AI infrastructure to develop applications that can enhance their competitive position, enable them to organically take market share, and generally drive superior revenue growth over the longer term without necessarily investing in the infrastructure itself. I mean, we do have some infrastructure investments. I think I mentioned Train in this presentation, which is selling HVAC equipment into data centers. We've also just yesterday seen very strong performance from a company called T Connectivity. That is a specialist in connectivity and sensor solutions, and they have some products which are sold into data centers and are unique, almost unique in enabling the kind of higher power and efficiency needed in that environment. But yeah, fundamentally, we're focused on the applications. I spoke a bit about healthcare adopting AI in this presentation. That is something which we think is going to be extremely important, actually, in future as we seek to improve efficiency in R&D spending in healthcare. I mean, that has actually been declining consistently over time. Healthcare companies, I think, have been throwing more and more money at R&D, seeing less return. And so AI adoption is something that we actually think could reverse that trend and really supercharge the healthcare industry. But even outside of healthcare, you know, we've mentioned a company called Rockwell, which is an industrial automation company based in the US. They're leveraging AI to optimize production lines and also to predict when a machine might fail before it actually fails, which can help to reduce downtime. And also companies like Schneider Electric use AI to optimize electrical load management in buildings. There are tons and tons of examples of companies in our portfolio that are using AI to save their customers energy, time, resources, costs. They're still in the kind of early days of adoption, I would say, but certainly this is something that we do think will drive superior equity returns as these companies, you know, leverage this technology to improve their competitive position and drive superior revenue growth.
So thanks, Claire. And while you've been talking, there's been a sort of follow-up question on AI, so I'm going to hold you onto that one whilst you've got the mic, which is how do we think about the sustainability impact, both positive and negative, of AI, and where does that put a company like NVIDIA in terms of its investability for a strategy like ours focused on positive impact?
Yeah, so we did actually perform some analysis specifically on NVIDIA to try to see if we could justify the kind of positive impact case for it, because they do have some components which do seek to save energy relative to kind of historic replacement components. But we just couldn't get there. I think a big issue with NVIDIA and with data centers as a whole is that they are, as I've shared earlier, ultimately driving a significant increase in power demand. And often at the moment, the reasons that people are using AI, you know, can't really be justified as having a positive sustainable impact. In our companies, we can see that happening, but as a whole, when we look at AI adoption across the world, across all applications, it's difficult to make a judgment that, you know, me using ChatGPT for life advice, for example, maybe a bit of an overshare there, is really having a positive impact. So this is the trouble that we have. I mean, when we can drill down and identify how it's actually being used, then when we can make a case for it, but as a whole, it's just not there yet, unfortunately.
Obviously, AI. Sorry, Sam, you go.
Just to jump in, one of the things that I presented in the impact report was Microsoft's growing carbon footprint, which is growing at an 18% CAGR, which means that it's doubling every 5 years. So yeah, these companies do come with a very significant and growing carbon footprint.
And I guess the other point is that, you know, AI can be used for positive impact. It can also be used for negative impact. And so we want to specifically look for the examples where there are applications being used for positive impact. So thank you for that. So we're just going to move back to on the questions to the water theme, just following up on what you've been talking about there. So one of the questioners saying that excited to hear about American waterworks and the opportunities there, but won't it cost hundreds of billions to replace all the aging pipes and upgrade all the aging infrastructure? And how will they cover the huge costs associated with these upgrades? So Seb, are you going to take a
Yes, I mean, you're quite right. It will cost a lot of money. It is costing a lot of money. It's a large part of that cost will probably be borne by water bills, by consumers. But it's this technology has moved on a long way, and we invest in businesses like Xylem, which have divisions that are focused on smart metering, better management of the water resource. We have businesses. One of the things that's still a perennial issue, it seems, in the water industry is leakage rates. We invest in companies that provide technologies that enable you to find leaks much more quickly, so that you're using your water resource much more efficiently. And also, there's quite a lot happening around how you incentivize users to stop creating the problem in the first place. So, even in this country, where, as Katie mentioned, the water industry is not generally held up as a good case study for anything really. But one of the things that has happened in recent years is water companies incentivizing farmers and other users of water not to use certain chemicals that create a problem for them downstream and add to the cost around filtering and cleaning up that water. So there's no question it will cost a lot of money. Some of that will definitely come back to bills. But there are clever ways of mitigating those issues and reducing the cost using better technology.
Sorry, mute on there. Thanks, Seb. That's very helpful. Just coming back and following up on the water side still, and coming back to Katie. This question in terms of you presented on 5 or 6 stocks there within the water theme. Which of those are you most excited about the prospects for in investment terms of those stocks that you listed there?
Great question. For me, I think I would choose Kurita Water. It really stands out against its peers because it has that broad technical expertise, which spans both the chemicals and the facilities. It also has a really high proportion of recurring service revenue, which provides a kind of layer of stability for its earnings as well. When we bought the stock back in January, the multiples were really attractively valued, well below the 5 and 10-year averages. And in April, they announced some really great earnings due to margin expansion, and they upgraded their guidance from the electronics sector, that kind of semiconductor spending cycle, which we're kind of seeing in action there. And we really see that momentum continuing.
Great, thank you, Katie. Another more specific question this time, I think, for Claire, just in terms of the HVAC sector, saying we talked about the HVAC sector. Can we talk about the current and future impact of refrigerants in that space?
Yeah, that's another really good question. So, of course, refrigerants have been historically detrimental to the environment. I think if you've been signing on to our webinars recently, we have in the past shared a chart, which I wish I had available now, which shows the carbon footprint and global warming potential of different refrigerants over time. And basically, we've seen consistent policy initiatives come out that have forced the HVAC sector to use refrigerants that have a better carbon footprint over time. And actually, in the US, we've just come through a new policy in specifically residential HVAC equipment, where the US agency has basically said that new sales of HVAC equipment have to use a specific refrigerant, which has a very minimal, actually, carbon footprint relative to previous refrigerants. And so this is something that has historically been driven by policy. I think it's difficult to encourage customers to buy refrigerants before those policies come into effect, but it is something that has historically been very effective at encouraging companies to adopt lower carbon footprint refrigerants. I think you mentioned Daikin in your question. They have historically been a leader in developing these lower carbon footprint refrigerants, and so that is one of the reasons why we have Daikin in our portfolio.
Good, okay, thank you, Claire. And just sticking with you, if that's okay, given the kind of the US sort of what's happening in terms of politics in the US and on a global stage, does that mean we're seeing more opportunities in a relative sense outside the US at the moment, or as it's affecting underlying companies, is that making no change? So what's happening to our geographic allocation and interest as a result of where sort of global geopolitics is heading?
Yeah, that is a question that we do get a lot. I think that there has historically been, as you probably know, a very marked outperformance of US equities relative to European equities, which is our kind of second biggest geographic exposure. And so there is somewhat of a question of whether that age is over, whether we are now seeing a resurgence of European equity outperformance, especially driven by valuation, which is a lot better in Europe than the US. I think from our perspective, though, when you look at, our portfolio is typically kind of mid to large cap. Most of the companies we invest in do have global revenue exposures. They do tend to have US dominance, but then I think that is true for most companies in our investment universe, just because of US's dominance in the global economy. And so there isn't that much, I think, opportunity for us to exploit any particular delta on US versus Europe economic growth, for example, simply because, as I said, all of our companies do tend to be global in nature. From a process perspective, we do have limits and kind of risk controls around geographic exposures. We do tend to try to be relatively flat and not take any top-down bets on which stock market is going to outperform another. And that just enables us to focus on stock picking. And so that is a bit of a limiting factor. But yeah, I would say ultimately we look to invest from the bottom up. We look at what the stock's doing, what its valuation looks like. Certainly there are some companies in Europe which look potentially relatively undervalued, but that could also be said for the US as well at this stage. So yeah, our focus is very much bottom up, but I guess it is something that we kind of keep in the back of our mind, but not something we necessarily try to exploit.
Great. Okay, thank you, Claire. That's very clear. So I'm just going to come to a last question to Seb, I think, by way of rounding up, which is that, do we think that, I mean, it's kind of linked in a way to what we were just asking you there, Claire, but do we think that the sustainability and impact world will remain dampened with Trump in charge, or do we expect a resumption of growth as the rest of the world realizes this is a healthy way forward? So I suppose that's wrapped into what points of optimism also do we see around the world for remaining committed to sustainability when much of the mood music has been rather more negative?
Yes, I mean, obviously it's, thank you for the question. It's clearly there's a very dominant narrative at the moment, both I would say in the media as well as in financial markets, that sustainability is kind of almost dead. There was a nice quote from that I used in the impact report about I've forgotten his name, but about someone basically reading in an obituary about himself in the newspaper, and saying that his death had been greatly exaggerated in that sense. And I think it feels very like that in sustainable investment as well. I mean, we're seeing quite a lot of obituaries being written for sustainable investment, and certainly the valuations would suggest that a lot of these stocks are kind of dead or dying. But then you look at the numbers, the actual data around what's going on, and it tells you a completely different story. The UN came out with a report on Tuesday that said that in 2024, 92.5% of all new electricity generation installed globally was renewable. 92.5%. In the US, it was 94%. Battery electric vehicles, which we have routinely heard obituaries about. There were 2% of passenger vehicles in 2014. There'll be 26% globally this year. In China, more than half of all new vehicles sold in China are battery electric or plug-in hybrids. So, it is a very different story when you look at the underlying data, and it tells you a completely different story to the narrative that we see in financial markets and the media. And of course, that does create this opportunity that we think is there for companies that are focused on these issues, and we expect that their valuations will bounce back as that data becomes better known and better established. So I think there are plenty of reasons for optimism, particularly if you're invested in sustainable investments like the WHEB Fund.
Thank you, Seb. And Jonathan has helpfully reminded online
Yes,
that
of
the
course,
quote,
Mark's
your
made
own
him.
quote was Mark Twain, but that rumors of his death have been greatly exaggerated. So I think that's a great note to finish on. So thank you for that. Thank you everybody for attending this morning, for listening in, for your ongoing support. We realize it's been a difficult and challenging period, but as we say, we think the opportunities going forward are really quite optimistic at this point, driven by much lower valuation multiples than we've seen for a very long time. And we think that that's a very solid platform as we set forward from here. So thank you everyone for all your time this morning, and we look forward to seeing you in due course. Thank you.